Good morning, ladies and gentlemen, to this interview entitled Successfully Capital Raising During COVID Times. That's actually what the program said. Initially, we wanted to have it post-COVID, but since COVID is still lasting, we thought that it was more appropriate to change and tweak a little bit the subject and do the subject on capital raising during COVID times. I have Michael Phillips with me this morning. Michael is dialing in from Munich. He's the co-founder of Castik Capital, founded it here in Lux in April 2014. Castik is pretty much the talk of the town here, not only because they are a Luxembourg-based equity firm, but on top of that, they do their job very, very well. They raised with their first fund, the Epic One fund, €1 billion, and the second one that they closed in October last year, so 2020, full in the COVID period. They raised a staggering 1.25 billion euros. Obviously, Michael, I'm not fishing for compliments, but first of all, why did you settle down here in Lux, and why did you decide to move to 100% onshore structure?
Sure. Good morning, Lou, and thank you for hosting me. Good morning, everyone. We had the luxury that we started Castik in 2014, and as a brand new fund, we had no legacy structures or concerns. And with this in mind, it became quite clear that onshore is preferable to offshore. This is really driven by government regulations increasing, substance requirements increasing, and if you have to choose today, you're just better advised to move to onshore and prepare yourself for the next 20, 30 years. And once you make that decision, really, Lou, Luxembourg is the only real choice today. It has the legal tax structures. It's easily accessible for most everywhere in Europe, and it has a talent pool of quality professionals. And so it was a pretty simple decision.
I mean, you're reasonably well known now already here in Luxembourg and as well internationally, but you like to differentiate yourself by your investment strategy. With what regards is your investment strategy different to the traditional private equity buyout fund?
Yeah, I think you're right, Lou. This comes into fundraising, that one of the keys is differentiating yourself. There's lots of PE funds. So we're set up as a traditional GP-LP. We have a few key differences. One is we have one single investment strategy, and that's to create European headquartered market-leading firms that can be global in nature. And we do this by consolidating fragmented industries across Europe. And we're a bit unique as the only firm really focusing on that strategy. Second, and probably our most important point, is we only interact with founders, and together with founders build these companies. And why founders? Because founders choose partners. They interact with you over many, many months in a direct process, and it's just by a company versus than in a pro forma, limited data access, run rate adjusted EBITDA process run by an investment bank. We do a focused portfolio, 6 deals in a fund, so very few large bets. That's because for us, each deal is a platform. And you typically invest 100, 150 million of equity on day one, and you invest another 100, 250 million of equity over the next 4 to 5 years. Again, no one else is offering a founder that sort of capital deployment strategy. And lastly, I think investors pay GPs to hunt alpha, to find unique deals. And the goal is once we find a great deal, we don't sell it after 2 to 3 years to get a quick exit. We hold our deals longer to maximize our return. And so our goal is to return our LPs 4 to 5x and still have IRRs of 20%.
I mean, this interview is about fundraising during COVID, and we know that the challenges for the entire industry is important. How did you manage to do it over this last 12 months? We just mentioned you closed in October, Epic 2, with a billion and a $1.25 billion raised. Can you give us an overview of the challenges of fundraising during that period? What kind of LPs were you targeting? How important is the track record and the brand? Obviously, you cannot go out anymore and see physically your potential LPs. So, how did you manage, nevertheless, to succeed? Is it easier? Is it harder? What are the takeaways from this exercise during these challenging times?
Sure. I guess the good news is overall the mechanics stayed the same. In fact, you could argue it was easier to make meetings online because no one was traveling. So you actually had the ability to interact probably more simply in terms of scheduling. And everything works. We can make meetings online, we can do Zoom calls, our virtual data room sets up, data transfer. So all of that was fine. What we found was extremely difficult was to engage with a brand new investor. And you asked about the kind of LPs that we're targeting. We're looking for very few large institutional LPs. Our goal as a fund is to have fewer larger investors that we treat better. And just to give you an idea, our first fund of 1 billion euros, we started with LPs, each one signing several hundred. Our second fund of 1.25, we now have just over 11 LPs, over 10 LPs. And what we found was it was the only people who can close in a new fund, a new LP relationship, were investors that we managed to physically visit and who physically managed to visit us in the back half of 2019. Because actually we started fundraising in April of 2019, really ramped it up in the second half, and starting in 2020, we quickly discovered we were only able to process the people in our pipeline to close. Our attempts to ramp up brand new
Michael, you're breaking
relationships.
up. Michael, just one
Oh,
second. You're breaking up. Would it be possible that you move a little bit closer to your screen?
yeah, sure, no problem. Is that better? Excuse me.
That's far better. Yes.
Okay, sorry about that. So anyways, what I was saying is it was very difficult for us to engage with new LPs that we hadn't had physical meetings with. And in fact, many took the meetings with us. We had calls online. They liked the strategy. And they said, I'm very sorry, for us to onboard a brand new LP relationship, we need to do physical visits at your offices. This wasn't possible. And so our fundraising really was a tale of two halves. People we managed to meet, we could close and onboard. People we weren't managed to meet, we began a relationship, but didn't onboard any brand new LPs virtually. And I think
With
the other
so
thing we
much
noticed.
capital available,
Go ahead.
go on, Michael.
No, I was going to say the only thing I'll notice is we also found that many of the pension funds and the fund of funds, they slowed their allocations in the May to August period. And so I think this was partially due to either general uncertainty. And in the fund of funds, we noticed that they themselves were having delays in their fundraising activities. So there was a knock-on effect.
With so much capital available, Michael, did you notice that the terms were easier to negotiate with your counterparts? And has the co-investment appetite changed during the COVID period, or is it business as usual?
Lou, it's never easier to negotiate terms with LPs. And for sure, the terms are never getting better from fund to fund. So I think there's an abundance of capital available. There's also new sources coming in. But I have to say there's still very strong discipline in the market. I think the terms are pretty standard. They didn't get worse from fund one to fund two, but I wouldn't say they're getting better by any means. I think you also asked a second question about co-investment. Is that correct?
Correct, correct.
I think the
Has
co-investment
the
trend of our
co-investment appetite changed?
no, I think co-investment has been a trend for 20 years in private equity, and it continues to increase. What we did notice, though, is during our fundraising, every investor we talk to, one of the questions they ask is, "Tell me about co-investment." And we offer our limited number of LPs guaranteed co-investment in our fund, which is unique. What we did discover, though, is that many LPs are actually struggling a bit to manage their direct co-investment programs during the pandemic. And I think this is a little bit of a reflection of LPs that are set up to invest in markets that are smooth and steady. Once you have disruptions, I think it's a different set of parameters that an investment company needs to have to decide is a direct decision still a good investment opportunity. We noticed that a lot of the co-investment decisions of LPs slowed during the summer. Luckily, that's all returned to normal in Q1 of 21. And going forward, we think co-investment is just a normal part of our fund business, and we, take the initiative and actually the commitment to offer our LPs co-investment.
In addition to your, I'd like to say, traditional business, you set up as well a so-called continuation fund for one of your portfolio companies. Was that continuation fund impacted by the COVID crisis, or was it dealt with similarly than for the traditional business? And can you maybe elaborate a little bit on this concept of continuation fund?
Yeah, absolutely, Lou. We have one very large, fast-growing company. It's done 5x in the last 5 years. We think it will 2 to 3x in terms of size of company over the next few. And so, as a goal, our mandate, we said, was to create a market leader, sell to our deliver to our limited partners 4 to 5x multiple of capital. We'd achieved that goal. But the company is a fantastic business. And I think let's discuss first what are the criteria we believe exist if you want to put a single company into a continuation or a single asset fund. It's a global business operating in 18 countries. Top line grows 10%. It's the undisputed market leader globally. It's 4 times bigger than number 2, 20 times bigger than number 3. It has a stable business model with 85% contractually locked in recurring revenue, and a diversified customer base where no large customer is larger than 1%. I think that's a unique set of criteria because an investor taking a single asset risk needs to look at that asset and decide that it has enough inherent diversification and stability to take a point risk on one company. That's why we thought this company would be suitable for a single asset fund. So we started to raise the fund in January of 2020 with a goal to close April 2020. That came to a roaring stop around mid-February. And we had a bit of a think and said, actually, we're so convinced that the company will continue to grow through the crisis. Let's just slow the process down, use COVID as a laboratory to prove to our LPs this is a great business. And so between March and September, we set up 4 direct streaming management presentations where our managers presented to 100 LPs we had. And we said, listen to the team, listen to what they've done. We gave them monthly updates of business performance. And by October, convinced a group of investors that this business wasn't just stable, but had grown through the entire COVID crisis. We held our first close on just under 500 million. Our target is 700 million in size in December. And we'll hold the final close now in March. I think for us, we tried to take the negative aspect of COVID crisis and turn around, improve. There's no better test of a company to follow through the crisis. I think that gave the LPs a lot of comfort that we're investing in a great single asset business.
Coming to another innovative strategy is the single asset funds. Can you elaborate on the rationale for raising a single asset fund, Michael? We've gone now through the classic, first the Epic 1, Epic 2, continuation fund, another strategy, single asset fund. What is it, and can you elaborate on the rationale for raising a single asset fund?
Yeah, sure. I mean, just to continue, our goal is to
maybe you break, Michael. You're breaking up again. If you can, maybe move a little bit closer to the screen.
Yeah. I hope this is better. With our single asset fund, we call it Epic 1B. He is the second fund for Epic 1. One of our Epic 1 portfolio companies will be sold. We are promising investors a 2 to 3x capital deal in a 3 to 4 year time frame. And it's very important to lay out the return expectations. This isn't a 2-year hold. We're not looking for a 1.5x, 45% IRR. We're looking to give our LPs a full buyout return as if they've been a co-investment. So 2 to 3x multiple of capital over a 3 to 4 year period in the base case. We set terms that are advantageous, we believe, 0.85% management fee, 10% carried interest, 8% hurdle, and a 5-year fund life. We're looking mostly at secondary funds, co-investment funds, and a few large institutional investors have signed on to this. And then I think, Lou, we should talk a bit about the conflicts of interest that exist, because there's 3 main issues to overcome.
Maybe can we keep that? Can we keep that, Michael? Can we keep the conflict of interest until the very end? Because there's a couple of additional questions I'd like to ask, and that's notably the criteria of selection. Upon what criteria are you defining whether a company can be placed or not in a single fund?
Sure. We want it to be probably a global business. We want to have, I'll say endless, but let's say absolute clear visibility for 10 years that the company will continue to grow at 7 to 10% a year minimum. So your investors are buying into a very long runway of growth, because that's the most secure way to ensure they have a solid return. We're looking for.
And is this a viable solution for every? Is this a viable solution for every portfolio, Michael? Surely not. It can't, can it?
No, I think within our first fund with 6 companies, we have one and potentially a second company would meet these criteria. So I think it's actually a very narrow subset of companies fulfill this requirement.
Okay. Coming back on the terms and conditions, especially for a single asset fund, what are the terms that you set for your single asset funds? Do they vary from the other terms and conditions, or are they similarly the same? And maybe as an additional question to that very first one, who are the limited partners that have an interest for this sort of product?
Sure. I think the benefit of the continuation fund is your capital is deployed on day one. So the fees are 0.85% of invested capital, and it's invested on day one, which is, I think, a big benefit for LPs. We've lowered the carry to 10%, a typical 8% hurdle, and a 5-year fund life. And this is really targeted at secondary funds, co-investment fund, and large institutional investors.
We have a question here from the floor, Michael. How do you envisage your long-term fund strategies evolving over the next five years?
The strategy for us,
pandemic
I think, stays
or not pandemic. Let us. Irrespective
I think
of
for us,
COVID, what is the fund strategy is evolving over the next 5 years?
Yeah, for us, the pandemic is more of an opportunity because our goal is to create a market leader, and we do this by lots of growth, lots of M&A and expansion. And a typical platform we're going to do is going to, our first one, we've done 75 add-on acquisitions over a 5-year period. And so for us, market disruptions, a crisis, it actually gives us opportunity just to continue our buy and build. And so we don't really see the pandemic as having a negative or a positive influence. It might create some opportunity. It slows growth down a bit. But overall, our strategy will remain unchanged. Our business model is independent of a 1-2 year COVID impact. And I think that's actually important. Our business model won't change, we don't think, for the next 10 years. We'll keep doing our buy and builds to create these market leaders.
The questions are actually flying in. So here's the next one. How would you structure a new startup for a new generation of digital infrastructure, Michael?
The fund digital infrastructure. Not sure I understand the question. A digital fund or a digital back office fund infrastructure?
The digital fund. Yeah.
Not sure I fully understand the question because we're not really a digital investor. So we're not looking to invest in pure digital businesses. We're looking very much to invest in IT, healthcare, business services. And I think the back office.
It's more from an investing. It's not from. It's more from an investing perspective. Is investing in digital companies very much on the agenda?
Not for us, no.
And you mentioned early on, obviously, the subject of conflict of interest. If you're selling to yourself, how are you dealing with a potential conflict of interest?
Well, we tried to solve this problem. The first is valuation. How do you know that the price you're selling from one fund to the next is the correct price? And so we hired an investment bank to run a third-party process, and we sold a minority stake to LPs, and that set a real arm's length market price. And that was the price we then used to sell the majority stake from the main fund to the continuation fund. I think that was the first key conflict. The second is, do you force LPs to roll? And we decided no. So we see it as two separate transactions. We're raising new capital for the continuation fund, and any existing LP has the right to reinvest, but has zero obligation to roll into the new structure. And I think that was a key factor to give LPs the choice. And the last one's the easiest. From a GP point of view, we have 100% reinvestment of our economics into the new investment. So we don't profit from the sale. And by solving price, reinvestment of LPs, and economics of the GP, I think we successfully solved all three of the criteria or the conflicts we could have had.
Tell you what, Michael, from a time management perspective, we are spot on, because I exactly have 6 seconds left of the time which was initially allocated to us. You've done an awful lot of things absolutely spot on since you initially came here to Luxembourg in 2014. Obviously, you said even the pandemic was an opportunity for you. The regulatory framework was beneficial as well. Do you have any sort of regrets over the last couple of years where you would have done things differently? And looking ahead of you, what do you anticipate as the main challenges for your industry going forward?
I mean, regrets, if you think back, you could always do things differently. But I think overall, we're quite happy with being in Luxembourg, and we're happy with how our fund is developed. The challenges going forward, I don't see any major hurdles for private equity. And the reason I say that is we now have another 10 to 12 trillion dollars flowing into the world, and that liquidity has to end up in valuations, public markets, asset management. Interest rates appear to be staying low for the next few years. And so I think this is again going to be a fantastic 3 to 5 year period for private equity. And my only concern, Lou, is that valuation multiples are going to continue to creep up. But that's just, I think, something we have to live with as an industry.
Okay. Well, on that note, thank you very much, Michael. If there's any additional questions or comments with regards to this interview, please direct them directly to Deloitte, and we have after forward them to Michael. Michael, many thanks for having you with us, and I look forward to seeing you very soon here in Luxembourg. And on this note, I close this interview and hand over to Matthew Vincent and his panel on the subject, Has the Game Changed for Cross-Border Funds Distribution? Many thanks, Michael.
Thank you, Lou.